Hello everybody, good morning, good afternoon, good evening, wherever you are from the world. Welcome back to episode 3 of my Passive Income Mastery TV show. So I'm Dennis Bay, and today we're going to be talking a little bit about what we call assets versus liability. So just a quick recap, in episode 1 we talked about the 4 kinds of people in the world. ESBI, right? E and S are what we call financially broke and time broke. B and I are financially free and time free. Okay, and I talked a little bit about episode 2. In episode 2, passive versus active income. What difference does it make in your financial future? And today we're gonna lead on with that to explain to you, to educate you about what are assets and what are liabilities, as well as cash flow. Okay, so what is an asset and what is a liability, and what is the meaning of the word cash flow? That is very, very important. Okay, so let's just take a look here. Imagine this is your bank account. Okay, so let's say this is your bank account over here. All right, now what is an asset? Okay, so let's take another color here. All right, okay, so an asset, okay, an asset is something that puts money into your bank account, okay, every day, okay, or every week or every month, right? So that is what we call an asset, okay? Now if you're talking about a liability, right, let's put liability here, okay? A liability would be taking money out of your bank account, okay? Alright, so liability would take money out of your bank account every day, every week, every month, okay? Right, so that is the main difference between an asset and a liability in simple terms, okay? Now, cash flow, what I mean by cash flow is how much money is flowing in and out of your bank account, okay? That's what we call cash flow, okay? So, alright, so if you have more money coming in, right, every single month, okay, than money going out of your bank account, then you have what we call positive cash flow. Alright, now if you have more money going out of your bank account, okay, compared with the money coming in, that means you're losing more and more money every single month in your bank account. That's called negative cash flow. Alright, negative cash flow. Okay, so obviously, which one do you want? You want positive cash flow or you want negative cash flow? Okay, the answer is very obvious. Of course, we want positive cash flow, right? We want more money coming in than the money going out of our bank account every month, okay? So that's a big problem that a lot of us face, right? A lot of our friends, a lot of our colleagues, people out there, you know, listening to this, even you, right, may be facing the same problem right now in your life. That means you have more money going out of your bank account every month compared with the money coming in, okay? So what this usually means that you have more liabilities, right, than your assets, okay? And we need to change that situation. That means we need to learn how to have more assets to put more money into our bank account compared with our liabilities, okay? Or what we simple terms, right, we call expenses, okay? That means our income must be more than our expenses. Therefore, our net profit coming into our bank account every single month or every single day is positive, okay? So in simple terms, we would say our income, okay, income must be more than our expenses. Alright, so we can see that there, okay, our income must be more than our expenses. Okay, let's write that again. Our income, alright, must be more than our expenses. And therefore, the net profit, okay, would result in positive cash flow, okay? And what we don't want every single month is a net loss. Okay? That's not what we want, okay? So we want to be in profit every single month, okay? We're making more money every month. We're not losing more money every month. You get it? Okay, so if you get it, Say yes. Okay, very simple, right, everybody? Now let me ask you a quick question here, right? If you drive a car, okay, most people drive a car, right? Okay, or maybe even 2 cars in your family, maybe even 3 cars, right? Because you live in a country where you know cars are not that expensive, okay, and you need it for a mode of transport. Okay, so let's say you have a car, maybe a Mercedes Benz, okay, or maybe a BMW, right? Or I don't know, maybe a Honda, okay. So your car, is it an asset or a liability? What do you think? Okay, so who says asset? Who says liability? Right? Well, it depends. Okay, it depends. Right? If your car is putting money every day into your bank account or every month into your bank account, then it becomes an asset. If your car is taking money out from your bank account every month, then it becomes a liability, right? So in simple terms, if you are driving the car yourself every day for transportation, and the car, you are paying for your gas, you're paying for your maintenance, you're paying for your engine oil, the servicing, the tires every year, every 6 months you need to change the tires, then it's a liability. So the more cars you have, the more expenses you have, and it's taking money out of your bank account every single day and every single month. Okay, you get it? So the car becomes a liability. Now, what if your car is owned by your company? Okay, and your company uses the car, all right, okay, to transport goods, right? So it's actually it becomes a tool for your company, right, to make money, right? Because your car is a delivery vehicle, right, and you're collecting delivery fees from your customers, okay, which pays for the car's expenses, and you actually earn a profit, right, by doing that. So then your car becomes an asset. Okay, so another good example is everybody's heard of Uber, right? So Uber, okay, so Uber all over the world is famous, okay, and in Asia here we have what we call Grab. Okay, so it's like a a copycat of Uber, right? So Uber and Grab, right? If you are a Uber Grab driver and your car, right, is owned by your personal company, then your car becomes an asset, because when you drive and you make money and you make more than what the car spends, right, on maintenance and gas and whatever, right, then it becomes an asset. All right. Otherwise, if you stay at home, leave it in the car parking lot, it doesn't move, it's still a expense to your company. It's still a liability. Okay, everybody get the idea? All right. So next question. Okay, how about your house? Okay, how many of you say your house is an asset? All right. How many of you say your house is a liability? Again, right? Again, the same situation. Okay, if your house is taking money out of your bank account every month, every year, because you're paying a mortgage to the bank, because you took a loan from the bank to buy your house and you're staying in your house, so you're actually paying the bank a loan, right? What we call a loan installment payment every single month. Then money is going out. Okay, money is going out, so it becomes a liability, right? But if you rent out your house, okay, and your tenant, right, is renting your house and paying a rent, okay, or maybe it could be you are renting out 2 rooms in your house, right, and you're staying in 1 room, okay, so basically your tenants are paying for 2 rooms, right, and if the rent is enough to cover your expenses on the house and your loan to the bank, and you have a profit, okay, you have more money coming in because of the rental income versus the money going out, right, paying the installments, paying the mortgage, and paying the maintenance on the house, you have a net profit, then the house becomes an asset. Okay, simple idea, right? So this is very, very important, okay, because most of us, right, think that, oh, some of you may say, hey, what if my house is appreciating in value over time? Okay, so that's another concept here called appreciation versus depreciation. So let's write that down. Appreciation, okay, versus depreciation. All right, what's the difference? Okay, let me ask you, right, for your car, okay, over time, as you drive your car for 2 years, 5 years, 10 years, does the value of the car go up or go down over time? Okay, so the answer is, of course, your car value actually depreciates. It goes down over time. That means if you paid $50,000 or $100,000 or even $1 million on your new car today, 5 years from today, the car would have depreciated maybe 50% of its value. 10 years, maybe just worth the metal body, which is like maybe just 1/10 or less of the actual price that you paid 10 years ago. Okay, so that's called a depreciating liability. That's a mouthful. A depreciating liability. Okay, so your car is not an asset unless you use it to make money. Okay, so that's what we call a depreciating liability, not a depreciating asset. Okay, a lot of people make this mistake. They think that the car is an asset, right? But it's not. Okay, so how about your house? Okay, so if you buy the right property, the right real estate in the right location, okay, that's very important, because when you invest in property, location, 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 the three key success factors of investing in the real estate. That means your house may appreciate in value over time. Okay, that means if you bought a house at $1 million today, or say $200,000 today, 10 years from now, that house could have appreciated in value to $300,000, to $500,000, or even to $1 million or more, depending on the location, okay, and how the real estate market is doing in your country, okay, politics and whatever factors combined. Okay, so many factors, okay, but anyway, most of the time, a real estate, a property in a good location will appreciate in value. So that's what we call appreciating assets, okay? That means even though you're paying a loan to the bank, but your house value is increasing, okay, every year. So that actually covers what you're paying as an expense out to the bank for your mortgage, okay? But it is still not a real asset yet until you decide to sell the house, okay? Because if you sell the house, then if there's a buyer, there's an exchange of money, then that cash going into your bank account would translate to a profit. Then your house becomes a real, what we call income generating asset, okay? So the whole idea of sharing with you this concept, right, is to let you know that, ask yourself, right, are you having more liabilities, okay, versus assets in your life? Are you having a net negative cash flow or positive cash flow in your bank account every month, every day, every year, okay? And are you having more income or more expenses? All right, so one last example here, right, which a lot of people you would have this in your wallets, okay, is the credit cards, okay, credit cards. So your Visa and your Master and your American Express credit cards, okay? So let me ask you, are these assets or liabilities? Okay, so this, you should be able to answer the question now, because ask yourself, right, do credit cards put money in your bank account or take money out? Okay, so think about it, right? The banks, right, want you to spend your money. The banks want you to owe them money so that they can charge interest, okay, on your expenses and your debts, okay? So the bank's business is built on your debt, okay? So the bank wants you to owe them money, be it $100, be it $50, be it $1,000, $10,000, $1 million. They want you to owe them as much money as possible. Why? Because in your bank, right, let me ask you, what is the interest rate, the savings interest rate that you have in your bank account every year if you just put your money there? And I'm not talking about a fixed deposit, I'm just talking about your normal bank account where you put your money there, okay? So here in my country, okay, it's pretty pathetic, right? It's about 0.1%, okay? And I know I've been around Asia and around the world, right? Most countries would hover maybe, for the good ones, maybe about 3 to 5%, maximum 3 to 5%. And that is in a country which is usually a developing country, because they want to attract you to put money in their bank account, right? But remember, when the bank, right, takes your money and they loan it to someone to buy a house, to buy a car, to fund their business, right, they actually will charge a higher interest rate than what they will pay you, and they make the difference. So that's how they make money. And so tell you a little secret, right? Please don't tell this to anybody else, okay? Keep it to yourself, right? The banks, right, are actually legally using your money to make more money for themselves. Okay? Alright, so doesn't make sense, right? Doesn't make sense. Right? Why do you want to keep your money in the bank when you can invest in assets that generate a higher interest rate, a higher return, okay, not interest rate, generate a higher return per year, right, versus that pathetic interest rate that the bank is giving you in your bank account, okay? Now, think about this, right? There's another concept I want to share with you called inflation, okay? Inflation. Alright? Go check on Google, right? Or check online, or ask your friends who are, in economics, okay? What is the current inflation rate in your country, okay? Now, usually, right, your inflation rate would be increasing, okay, over time, okay, as your country, gets more, prosperous and your economy is growing, your inflation would go up. That means your cost of your rice, your water, your gas, your everyday electricity is actually increasing, okay? So, assuming, right, if your inflation rate, current inflation rate is, say, 6%, okay, and your bank is giving you an interest of 3% on your savings, that means your money is actually shrinking every day, guys. Okay, why? Because if your food cost of living is going up at 6% a year, and your savings is only giving you 3% or less, what's 3 minus 6? That's negative 3%. That means your money in your cash in your bank account is shrinking in value by 3% every year, okay? That's why you need to learn how to invest in vehicles, assets, alright, which I'll explain in future episodes, to help you to generate higher return, right, every year that beats inflation. That means you need to generate returns from your investments and assets that is higher than 6%, okay? Or higher than your bank account, right? Otherwise, your money is growing smaller every single day, okay? So, let's revise here. Assets versus liabilities. Which one do you have more? Which one should you have more? Of course, you should have more assets, okay? And cash flow, positive or negative? Which one should you have more? Of course, positive cash flow. Income versus expenses. Which one should you have more? Of course, income more versus expenses, okay? And that will result in a net profit every month, right? And you are in what we call positive territory every month, okay? So the idea here is once you understand this, then you realize that, oh my god, I shouldn't be keeping most of my money in the bank, right? Because our parents tell us that work hard and save money in the bank, okay? So you need to rethink that concept, right? If you want to get rich, rich people don't save money in the bank. Rich people invest in assets, right? And they cut down on their liabilities, or they know how to manage what we call good debt versus bad debt so that they have a net profit and generate passive income every single day, week or month into their bank account, right? So basically, that's it for today's episode, right? So look forward to seeing you in the next episode where I continue to educate you more about passive income mastery. So I love passive income mastery. I'm Dennis Bay. See you guys on the next episode.